Hello, very good morning to all and happy Friday. Welcome to today's Daily Dose of Market Insights. I'm Kelvin here again, and today will be a very special Daily Dose of Market Insights because towards the end of the Market Insights, I'll be drawing 6 lucky winners to our Fly to New York lucky draw that we conducted late last year. But without further ado, let's have a quick look at the disclaimer slide first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast prediction or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, for our daily dose, we will start off with giving a snapshot what has taken shape yesterday in terms of the intraday performance of the broad-based cross-asset classes, ranging from the major dollar pair, the major stock indices, and as well as any key data or news flow that could impact the short to long-term performance of these broad-based cross-asset classes. And also, we will have a intraday technical outlook on the major US dollar pair for those who follow our daily dose on a daily basis, ranging from the euro dollar, the sterling dollar, the dollar yen, the Aussie yen, and as well as the major stock indices, all right, ranging from the Nasdaq, the SPX, the Hang, the Nikkei 225, as well as the German DAX. And lastly, we also have the short-term technical outlook on the two key commodities that we cover on a daily basis as well, which is the gold XAU/USE, gold XAU/USD, pardon me, and West Texas crude oil. And like I mentioned at the start of today's daily dose will be very special because towards the end of today's daily dose, I'll be drawing a Fly to New York lucky draw. So I would OANDA would like to thank for those who have participated in the last 3 months that we held from October, November, and December for the qualifiers. So for those qualifiers later, I'll actually draw out 6 prizes, all right, 6 prizes. So we have 5 runner-up prizes worth 200 Singapore dollars of Capital Land voucher each, and lastly will be the all exciting number 1 grand prize, which is a round trip for 2, a trip to New York that is worth up to 5,000 Sing dollar. So do stay tuned towards the end of today's daily dose, where I'll be drawing these 6 lucky winners live for today. All right, so without further ado, let us kickstart today's daily dose first, starting with the key news flow of what has taken shape yesterday. All right, so as you know that yesterday was actually the closure of the US stock market. So the US stock market didn't open yesterday because of the morning day, paying a special tribute to the recent passing of ex-US President Jimmy Carter. So yesterday the US market didn't open, but we do have a series of news flow pertaining to the medium-term monetary policy stance of the US Federal Reserve, which is very important. Why? Because it could impact the broad-based cross-asset classes across the board, ranging from the FX, the stock market, and even the commodities market. So yesterday, we do have a slew of Federal Reserve officials speaking. So I will highlight the couple of important ones yesterday. So yesterday, we do have Fed Bowman. So Fed Bowman actually flagged inflation risk over here. So for those who followed my daily dose of market insight, I do highlight that the US break-even inflation is rising at a very fast pace. So that actually also support a very firm US dollar strength in the last 2 weeks. And she actually encourages a cautious approach over here. That means, i.e., based on her point of view, the Fed shouldn't be so dovish in 2025 as compared to the start of the interest rate cut cycle that was kickstarted in September last year. And there's another for Baking, he did mention that the current push up in the US 10-year Treasury yield is more related to the term premium. So term premium is taken away as something like investors are paying much more of a higher risk to own longer term US debt, which is US Treasury, but it's not related to inflation. So it's more likely related to the potential longer-term US budget deficits that could be impacted by the incoming Trump administration policy, where Trump advocated for steep corporate tax cut over here. All right. But he also did mention that, okay, I don't think it's inflation. I think it's term premium, and the term premium has something to do with risk. So this risk is more like is pointing to the widening U.S. budget deficit risk over here. All right. So another U.S. Federal Reserve official speech, Fed Harker, he says that more rate cuts are coming, but timing is uncertain. And he also did flag out that inflation is on the path to 2%, but taking longer than hope. So this is also kind of a less dovish, subtle, less dovish guidance as well, coming from this Federal Reserve Fed Harker. So all in all, after a slew of Federal Reserve officials speaking yesterday, the market expectation on future interest rate path in the US still kind of remains unchanged. So how do we know that? By looking at the CME Fed Watch 2. So if you look at the CME Fed Watch 2 over here, based on the latest pricing as taken from the Fed Funds Futures Market. So we know that the upcoming FOMC meeting will be on the 29th of Jan. So on 29th of Jan, market participants are assigning a high probability of 93% that the Fed will remain on hold, keeping the Fed funds rate at 4.25% to 4.5%, because this is the current target rate, right, at 4.25% to 4.5%. And if you look at across the board, right, since a day ago, so that was before before a slew of Federal Reserve officials speaking yesterday, it was at 94%. Yesterday, it only reduced slightly by one percentage point of 93%, but it still remains higher by 1 week ago at 88%, and also higher by 1 month ago, which was a probability of 65%. And the good thing about the CME Fed Watch 2 is also allow us to gauge what is the probability right now, because this is not really that live. It's based on a lagging of 2-hour data, but I would say consider as a good gauge based on the current Fed Fund futures pricing. We also able to have a sense of what market participant is assigning according to probability by the pricing of this Fed Funds futures market. What will be the Federal Reserve policy like for the next few meeting, stretching all the way up to the end of this year, by clicking on this one called aggregated tab. All right, so on this aggregated tab over here, for those who follow my daily dose on a frequent basis, so what we could see over here is that currently it's at 4.25%. So it will remain on hold for uh, January and as well as 19th of March. Okay, and the next one to bring it down to 25 basis point, which is at 4.5% to 4.25%. So these are the Fed funds target rate at 4% to 4.25%. So there will be a reduction of 25 basis point. In order to come down to here, if you look at the probability, the ones highlighted in light turquoise green, 66% high chance it will come in May. All right, over here, then after that, which is slightly above 50%, then we have 93% chance in June. So it's either May or June. Usually they assign the highest probability is in June. Then thereafter it remains stand pat all the way, and there could be a probability of another interest rate cut at a quite high, about 70%, which is above 60%, coming at the end of this year, which is on the 10th of December. So if you look at the current market pricing over here, market is only assigning 2 interest rate cut potentially for this year. One coming in somewhere around coming in 18 either May or June, then followed by December this year, which is the 10th of December FOMC meeting. So with this less dovish Fed that is being kind of expected by market participants in the, and also based on yesterday's slew of US Federal Reserve latest speeches, we will tend to see the dollar remains on a very firm uptrend. Okay, so by looking at the US dollar index, it continues to trade within this medium-term ascending trend line from the low of 1st of October. All right, and also holding above the 20-day and the 50-day moving average. The daily RSI still not showing any signs of bullish exhaustion because there's no bearish divergence, and it continues to hold up by this ascending trend line support. by displaying a series of higher low, right? So this measure the medium-term momentum of the US dollar index. So it's indicating that this medium-term uptrend is supported by a bullish medium-term momentum, and also based on a intermarket dynamics, the longer-term US 10-year Treasury yield is also shaping this medium-term bullish uptrend phase, holding above the 20-day and the 50-day moving average after this major bullish flag breakout on the 18th of December last year. But I want to stress that later when I cover the intraday technical outlook, we know that intraday movement price action could actually mean revert within its longer term trend. So there could be signs that yes, we know that the medium term uptrend of the dollar still intact, but for today, there could be some potential dollar strength setback when I cover the intraday technical outlook chart using the 1 hour time frame instead of the daily time frame. Later, you guys will have a better view of the intraday technical outlook for today, but that only good for 1 day for today only. All right, so we'll cover that on a daily basis. So every day in my daily dose, starting from Monday to Friday, unless there's a public holiday in Singapore or when I go on leave, I will be covering this slew of latest intraday technical outlook on the major dollar pair, the major stock indices, and the two key commodities. So to get access on how to listen it live that you are seeing here right now at 11 a.m., do reach out to us. We could able to help you to actually sign up for that because there's some criteria to meet in order to listen it live on the daily basis. All right. So now, so and also another particular longer term news, medium term and longer term news flow is more pertaining to the dollar yen. We know that Japan is on a path of different monetary policy against the rest. So we know that last year, most of the major central banks, ranging from Bank of England, ECB, the Swiss Central Bank, Bank of Canada, and even definitely the Fed is on a path of interest rate cut cycle. But however, Bank of Japan is different. They are embarking on a normalization policy to bring interest rate from negative territory up to positive, but on a very slow pace. Right? They not increase at a very fast pace because that could create a negative feedback loop into risk asset, which has taken shape in late August last year when they suddenly hike interest rate, and we still see a sell-off in the yen crosses, which translate to a sell-off in the major stock indices. So they don't want that to take that happen again, and they now try to gradually increase interest rate hike, but on a gentle basis. And yesterday, Bank of Japan actually sees that there will be a potential chance of further wage hikes in Japanese corporation this year, which actually signal higher chance of near-term rate hike. So Bank of Japan will meet in January this year. So there's actually a high chance that a probability that in the January meeting, which is about 2 weeks from now, that they could actually hike one more time. So that's why you see the dollar yen was actually quite flattish yesterday. So for those who followed my daily dose yesterday, I do mention that the dollar yen has hit our short-term resistance level that we been bullish bias for the start of this week at around the 1580 40 level. So there's actually a risk of the dollar yen doing some kind of mean reversion decline on the intraday basis. Later I'll touch more about that on the dollar yen when I cover the intraday technical outlook chart. So this is the 5-day rolling performance of the US dollar against other major currency as we are speaking right now. So we got see over here is that the price action of the dollar has started to trade sideways as well. So one of the reasons why this sideways movement of the dollar is because yesterday the US stock market, cash stock market is closed because lesser liquidity that's impacting the US session. And also later when I cover up the economic calendar to watch data to watch out for today will be the all important tier 1 US labor market data, which is the headline non-farm payroll data, as well as the US unemployment rate. So market participants is waiting for this particular news flow to release that could create a potentially sometimes could create two-way volatility, spike up and spike down on the major dollar pair. So less hesitant to take on any fresh open position right now on the intraday basis. All right. So now with that, that actually covers the first segment of today's daily dose. All right, which is the intraday movement, which is the yesterday's we call it price action movement, and as well as several key economic news flow that I want to share with you all that could impact the markets from a medium term perspective. So without further ado now, let us now jump straight into the intraday technical outlook on the major cross asset classes, starting from the FX market. So with that, let me expand my screen so that you guys could have a better view of the charts. All right. So now let us start with the FX market first over here. All right. So on the FX market, let us start with the euro dollar. All right. So for the euro dollar, we have maintained that bearish bias since Tuesday. Previously on Monday, we look out for the mean reversion rebound. The mean reversion rebound take shape, hit our resistance at the 10420 and start to slide downwards. And we've been tightening the key short-term pivotal resistance level. And yesterday it just traded sideways, still holding above our first support level at 1.025, but it continues to trade below the 20-day MA and the 50-day MA, as well as this minor descending channel that I drew from the high of 6th of December. So right now, the hourly RSI has now start to shape a higher low after hitting its oversold region. So there could be some chance, given that either upon the release of the non-farm payroll data, to see a bit of spike up over here. So this spike up could take us as high as 1.0330 and potentially could also be retesting slightly below the short-term pivotal resistance level at 1.0380. And this short-term pivotal resistance level is very important. Why? Because it confluences with several different angle of elements that we define as a key short-term resistance. Number one will be the upper boundary of this medium-term minor descending channel that I drew from the high of 6th of December, coming very close to this downward sloping 20-day moving average, and as well as if you do the Fibo retracement, taking out from the high of the sell-off after hitting our first resistance level where we played the mean reversion rebound since late last Friday, all the way down to Wednesday's intraday low, that also confluence with the golden ratio of 0.618%. And for those who are new to the daily dose, I'll be using this is trading view chart over here. In trading view chart, even though we are on an hourly time frame, I could actually overlay it with a higher time frame indicator. So this time frame indicator is not the 20-hour moving average. In fact, it's the 20-day moving average. So what I could do over here in trading view is that every time I switch to a lower time frame chart, this 20-day moving average will be fixed on the chart. So that's the beauty of trading view. I'm able to do multi-time frame analysis on a single chart. So net overall, we will still maintain that intraday bearish bias on the euro dollar, but bear in mind there could be a spike up during the European, as we head into the European session, into the early US session ahead and before the non-farm payroll data. Because of it's a highly volatile event, there could be a spike up 1.0330, maximum 1.380. So potentially we could be using this spike up to fade the potential strength of the euro dollar, as long as 1.0380 short-term pivotal resistance is not surpassed to the upside. We will still have that intraday bearish bias. First support level, you got to break down, definitely for sure be the 1.0250 level. Only a breakdown below this level exposes 1.019 next, which is a Fibo extension cluster level, 1.382 and almost 2 times, and as well as the lower boundary of this minor descending channel that I drew from the high of 6th of December. Only an hourly close above 1.0380 will invalidate today's intraday bearish bias to kickstart a extension of the mean reversion rebound again, revisiting 1.0420, 1.0460, and above it sees 1.0510 potentially, if which is correspond to the downward sloping 50-day moving average. All right, so that's for the euro dollar. What's up next for the sterling dollar? So the sterling dollar was actually a weaker pair versus the euro because of that risk of that widening budget deficit in the UK economy that sparks fear again of the we call it a budget crisis, or the US guilt crisis, we call it. So what's interesting over here is that the sterling dollar actually came down, printed a low yesterday of 1.2238, slightly above 38 pips above our first support target at 1.22 figure. For those who followed my daily dose yesterday, we do have a bearish bias looking for it to test the 1.22 figure. But after hitting that 1.22 figure over here, it just trades sideways as well. But the RSI starts to behave rather positively. What you could see on the RSI over here, it hit the oversold region, and after hitting the oversold region, it starts to flash out a bullish divergence. So price action of the RSI showing higher low, but price action on the sterling dollar start to show a lower low. So what it means that the downside momentum from the sell-off that taken shape this Tuesday all the way up to yesterday's intraday low, the downside momentum has starts to dissipate. That means if downside momentum starts to dissipate, there could be a risk of a much more pronounced rebound taking shape. And we know that, look at the sterling dollar. The sterling dollar has lift the 20-day moving average by a big gap over here. I could see over this big gap. So there could be a chance of a mean reversion rebound back towards the 20-day moving average again. And this big gap over here seems to be has a much bigger gap as compared to the euro dollar. All right, the euro dollar over here. So the euro dollar actually didn't print lower. It didn't break below the low of last Friday, whereas the sterling dollar has really broken the low of last Friday over here. Okay, so what I could see over here, given this mean reversion, given this bullish divergence on the hourly RSI, there could be a much more higher chance of a steeper rebound taking shape for today. So and it has really left the move. It has a more further spaces to actually retrace back to the 20-day moving average. So with that, we will flip to a intraday only for today. Bullish bias on the sterling dollar within its medium-term downtrend that is still intact. So this is an intraday movement that it potentially could last for today only, using 1.22 figure level as my short-term pivotal support level. First resistance we got to watch out for today will be at 1.2375, 1.2405. Only a breakout above 1.2405 will potentially see the mean reversion rebound extending towards 1.2480 next. But however, if price action starts to break down and have an hourly close below 1.22 figure level, then this mean reversion rebound will be invalidated, and we will see the sterling dollar continuing its downside momentum or impulsive down move, exposing the next near-term support level at 1.2140, followed by 1.2080 for today, which is the 1.618 Fibo extension, and this 1.2080 also confirms with the lower limit of this pink channel, which is our medium-term descending channel that I drew from the high of 27th of September last year. So net in a nutshell, because of a positive, we call it element or positive bullish condition that's been flashed out on the hourly RSI, there could be a chance of a mean reversion rebound taking shape on the sterling dollar for today, which is on the intraday basis, using 1.22 figure level as my short-term pivotal support level. First resistance it got to surpass will be at 1.2375, followed by 1.2405. Okay, so that's for the sterling dollar. So turning our attention now will be the major dollar pair against the Asia Pacific currency, starting with the Aussie dollar. So the Aussie dollar also traded sideways, hit a on Thursday during the European session, hit a lower low, okay, a lower low over here, and hit our first support zone of 61.80, 61.60 that we mentioned also yesterday. So upon hitting our first support zone over here, we see the RSI, not the RSI, the raw price action of the Aussie dollar printed a lower low. But on the RSI, it starts to shape a bullish divergence as well. Very similar observation that we have seen on the sterling dollar, right? There's a higher low over here. So indicating that yesterday's push down or yesterday's bearish momentum has also starts to get dissipated as well. So there could be a chance of a mean reversion rebound taking shape in today's intraday section for the Aussie dollar. So I'll be using 61.80 for sure and 61.60 as my short-term pivotal support for today. We will flip to a intraday bullish bias only for today for that potential minor mean reversion rebound scenario that may play out because of that bullish divergence that's being flashed out on the hourly RSI at its oversold level. All right, first resistance to watch 62.60/62.90, which is the downward sloping 20-day moving average, where previously price action got rejected on the 6th of Jan and 7th of Jan, and as well as the upper limit of this medium-term descending channel that I drew from the high of 1st of October. All right. So, but however, if price action starts to shape a hourly close below 61.60, then this intraday bullish bias for that mean reversion rebound scenario will be invalidated to see the continuation of the impulsive down move, exposing the next near-term support in first step at 61.20. A breakdown below it sees 60.55/60.30, which is the lower limit of this medium-term descending channel. All right, so that's for the Aussie dollar. Flipping to a intraday bullish bias for today only for that potential mean reversion rebound to take shape, potentially because of that bullish divergence. using 6180/6160 as my short-term pivotal support level. So lastly will be the dollar yen. So the dollar yen has been hesitant, can't break above the 150.80 short-term pivotal resistance level. So we'll be using this 158.80 as my short-term pivotal resistance level, looking for it to do a mean reversion decline back towards the 20-day moving average over here. So first support level to watch for today on an intraday basis, okay, will be this level here at 157.50. Let me put it in writing. 157.50. All right, so a breakdown below 157.50 exposes 156.70 next, which also correspond to the 20-day moving average, maximum 155.95, which is this potential range, with current range, a minor range, we call it configuration, that has taken shape since the low of 20th of December last year. However, if price action see a breakout above 158.80, then potentially this minor mean reversion decline scenario will be invalidated to see the continuation of the impulsive up move towards the next resistance level, 159.45. The major big one, which is the major risk level, is 160.30. Why this 160.30 or 160.30 level is important? Because if you look back over here, this 160.30 actually saw that last BOJ intervention as instructed by the Ministry of Finance. Okay, the last Bank of Japan intervention, where you see over here, once it hit the 160.30 level, so there's a huge spike down. So this is where it created that intervention by Bank of Japan as instructed by Japan Ministry of Finance to actually sell the dollar and buy the yen. So after it broke down the 160.30 level during 11th of July last year, you see the dollar yen actually plummeted for close to about 3.5 months. Close to July, 2 months, all the way down to August low of 141. All right, then thereafter it starts to bounce back up again to this level. So this 160.30 will be a major resistance and risk level to watch for dollar yen. So for today, on the intraday basis, we'll be still using 158.80 as my short-term pivotal resistance level, maintaining that intraday bearish bias for that minor mean reversion rebound to take shape. First support level to watch, 157.50. A breakdown below it sees a further extension towards 156.60 next, which correspond to the rising 20-day moving average as well, very closely. So that's sum up the intraday technical outlook on the major FX crosses. So now, major dollar FX crosses, pardon me. So with that, let us now go to the major stock indices, starting with the Hong Kong 33. Hong Kong 33 is what we call in our platform, which represent the Hang Seng Index. So the Hong Kong 33 representing the Hang Seng Index continues to remain lackluster ever since the what you call it, the failure to break above 20,150 since during the holiday season, that means the Christmas season as well, and it got rejected again last this Monday over here, and it starts to trend downwards. All right, so with that, it managed to hit our first resistance level in today's Asia session, 19,336, come break down and it starts to sell off right now. So I don't put our key short-term pivotal we call it resistance so tight because it hasn't broke down below our first support yet at 19,030, unless it's able to break down below 19,030 during the later part of today's Asia session with an hourly close below it, then we will tighten the key short-term pivotal resistance to 19,340. So for now, we're still using 19,580 as my short-term pivotal resistance level, maintaining that intraday bearish bias on the Hong Kong 33, i.e. representing the Hang Seng Index. A breakdown below 19,030 exposes the next near-term support level at 18,460, which correspond to the 200-day moving average as well. Hourly RSI still remains bearish, hasn't hit the oversold level yet. And if price action starts to stage a bullish breakout above 19,580, hourly close above it, today's intraday bearish bias will be invalidated to see a potential squeeze up to revisit 20,150 next in the first step. Only a breakout above 20,150 sees a steeper mean reversion rebound towards 20,520 next, which is the minor swing high of 11th of December and 13th of December last year. And if you do the Fibo retracement of this ongoing minor decline, minor short-term downtrend phase from the high of 10th of December all the way down to yesterday's intraday low, is close to the golden ratio of 61.8%, which confluence with the 20,520 resistance. All right, so net in a nutshell, still maintaining that intraday bearish bias on the Hong Kong 33 using 19,580 as my short-term pivotal resistance level. Now, turning our attention will be the Japan 225, which is representing the Nikkei 225. So for the Japan 225, that's called in our platform, continues to be stuck inside this trading range, right? This short-term trading range over here of 40,155 and 39,180 over here. And if you look at it from a longer term perspective, right, since September 27th of September, it has been stuck in this medium term complex sideways range. Can't break above the upper boundary of the range at access at 40,420. So with that, on the intraday basis, we still keep it wide, still trading within this range on the intraday basis. So still neutral between 40,155 / 40,420, and the lower limit of the neutrality range will be at 39,180. Unless today we have an hourly close below 39,180, then I could validate a potential bearish exit from this neutrality zone, exposing the next near-term support level at 38,870 / 38,730, which correspond to the 200-day moving average. A breakdown below it sees the minor swing low of 19th of December coming in as acting as a next near-term support level at 38,315. So that's for the Japan 225, still maintaining that neutrality stance between 40,155 / 40,420 and the lower limit of that neutrality stance, 39,180. Now, what's next for the German 30? So the German 30 continues to be holding above our support level. The first support level is at 20,250, and the key pivotal support that we have yesterday, which is correspond to the rising 20-day moving average, will be at 20,150. So price action continues to be holding above this RSI support level as well. With that, I don't put it so tight at 20,250. So that will be my first support level to watch for any potential dip, but still using 20,150 as my short-term pivotal support level. As long as price action didn't surpass below 20,150, which is for the 20-day moving average for the German 30, i.e. the German DAX, we'll still maintain that intraday bullish bias for it to retest the current all-time high area at 20,470 / 20,520. Breakout above 20,520 sees the next resistance coming in at 20,650, which is a Fibo extension cluster level. And this 20,650, if I go to the daily time frame chart, is also the upper boundary of this major ascending channel that I drew from the low of almost 2 years ago, one and a half years ago at 28th of September 2022 low. Okay, it's about 2 years plus of price action. Okay, 1 hour chart. Okay, so but however, if price action starts to have an hourly close and a breakdown below 20,150, this intraday bullish bias on the German 30 will be invalidated to see the start of a potential mean reversion decline scenario, minor one in first step, testing the 20,000 former minor range support now turns into a former minor range support now turns into a pullback. Former minor range resistance now turns into a pullback support, and so correspond to the minor trendline support, linking the higher lows since 20th of December. A breakdown below 20,000 exposes 19,840 next. All right, so i.e. in a nutshell, still maintaining that intraday bullish bias on the German 30 using 20,150 as my short-term pivotal support level for the German 30. Now, next up will be the major US stock indexes. So I did mention the major US stock index yesterday didn't trade much because of the closure of the US cash market yesterday. So on the hourly hours chart on the US Wall Street 30, which is representing the Dow Jones Industrial Average, we'll still have that bearish bias. First resistance level to watch 42,960, still using the 43,160 / 43,350 as my short-term pivotal resistance level. Next support level to watch out for on the daily basis, on the intraday basis, will be 42,210. If price action starts to break down below 42,490, only a breakdown below 42,210 exposes the major support level at 41,840. So this 41,840 slash 41,590, this major support zone here is rather important. Why? If we go to the daily time frame, it's actually the lower boundary of this ongoing major ascending channel that I drew from the low of 27th of October last year. Okay, so now back to the hourly chart. If price action managed to stage a bullish breakout above 43,350, if hourly close above it, then we will potentially kickstart a recovery phase in first step on the US Wall Street 30, i.e. the Dow Jones Industrial Average, exposing the next near-term resistance level at 43,720 and 43,916. So i.e. still maintaining that intraday bearish bias using 43,160 slash 43,350 for the short-term pivotal resistance on the US Wall Street 30 index. So lastly will be the Nasdaq 100. So the Nasdaq 100 also continues to trade within this minor descending channel that I drew from the high of 18th of December, and also failed to break above the 20-day moving average that is acting as a similar resistance level as the upper limit of this minor descending channel, which is our pivotal resistance that we have for yesterday as well at 21,530. So with that, we are still maintaining that intraday bearish bias using 21,530. But first resistance level to watch will be 21,350. So as long as there's any potential bounce didn't break above 21,530, we will still have that intraday bearish bias on the Nasdaq 100. With that breakdown below 21,040. So unless we have a breakdown below 21,040, then I could tighten the pivotal resistance level to 21,350, because now it may still bounce over here. So unless we have an hourly close during the European session below 21,040, then I could tighten the pivotal resistance to 21,350. So for now, the pivotal resistance is still at 21,530. Breakdown below 21,050 exposes this minor range resistance that is still in place since the low of 20th of December, now acting as the next near-term support zone at 21,860 slash 21,780 next. However, if price action have an hourly close above 21,530, then today's intraday bearish bias will be invalidated for the Nasdaq 100 to see a recovery to retest 21,730. Above it sees 21,890 next. So that sum up the intraday technical outlook on the major stock indices. So with that, let us now take our shift our attention to the commodities market, starting with gold XAU slash USD. So for gold XAU slash USD is now testing our short-term pivotal resistance level that we have at 2,674 that we highlighted yesterday, but price action now has started to trade above the 50 and the 20-day moving average. So overall, what I could see is that this gold XAU slash USD, since the low of 14th of November, that's about close to around 2 months. So in 2 months, it has been trading in this kind of range configuration. So it hit the lower boundary of this range. So this is an ascending trend line. So potential, then this is two similar swing high. So what I could see over here is that potentially it could be involving in a minor ascending triangle range configuration with the upper limit of the range at 2,716, 2,728. The what I call it, the minor ascending triangle range resistance level, and now it's trying to actually inch up higher towards the upper limit of this minor ascending triangle range. And if you look at the hourly momentum as well, the hourly RSI also starts to print a series of higher low right above the 50 level mark. So with this positive momentum reading in the hourly RSI, we will flip to a intraday bullish bias for today on gold XAU slash USD, given that it hasn't broken above 2,675 near-term key resistance level. I don't want to type my I don't want to have a very tight pivotal support level at 2,663. So this will be my first support level to watch in any potential dip using a lower level 2,650, which is the congestion area here, and so confluence with the 50-day moving average. That will be my short-term pivotal support level for today. Flip to a intraday bullish bias within this minor ascending triangle range configuration for gold XAU slash USD. Above 2,674 exposes 2,690, and above it sees the upper limit of the range resistance coming in at 2007.16, 2007.28. Only hourly close and a breakdown below 2006.50 will invalidate today's intraday bullish bias to see it floating down towards the lower limit of its minor ascending triangle range configuration. In first step, exposing 2006.40, a breakdown below it exposing 2006.14, 2006.10 next. So that's for gold XAU/USD. So now lastly will be the short-term intraday technical outlook segment, where we will cover the West Texas crude oil over here. Let me load up the chart of the West Texas crude oil. So for those who join our daily dose for the first time, so let me take you through the bigger picture of West Texas crude oil first. So for West Texas crude oil, since 20th of March 2023, low of 67.55, 65.70. So that's our medium-term pivotal support zone. It has been trading in this major descending triangle resistance, and recent price action has really hit the 200-day moving average, coming very close to the upper limit of this major descending triangle range resistance level. All right, and with that, on the hourly time frame chart, yesterday we do have a tightened key short-term pivotal resistance over here. So price action during the European session come break below the 73 figure level and start to bounce up. And right now there is a bearish candlestick that is got rejected at the pivotal resistance that we highlighted yesterday. So using the tightened short-term pivotal resistance that we have yesterday at 74.60, so we will still maintain that intraday bearish bias for West Texas oil. First support level to watch for today will be 73. Only a breakdown below 73 figure level exposes the next near-term support level at 72 figure, which also correspond to the rising 20-day moving average. Only a hourly close above 74.60 will invalidate today's intraday bearish bias to see a squeeze up to retest the 200-day moving average that is acting as a resistance level, and the minor swing high of this Wednesday at 75.30/75.80. Only a breakout above 75.80 sees a potential squeeze up to retest the upper limit of that major descending triangle range configuration that I shared with you on the daily time frame chart a while ago, which is at 76.70/77 figure. All right, so that sum up the intraday technical outlook on the broad-based cross asset classes. So with that, now let us take a look at the economic calendar on what are the key data to look out for, either than the non-farm payroll data that is due later today during the before the opening of the US cash market. Okay, so today will be Friday over here. So Friday over here, let us see the European session. So during the European session, what we could see over here is that there's nothing key in the European session to monitor. But for those who are interested in any particular Canada dollar pair or the Canada dollar crosses, we also have a slew of important Canada job market data that is out at 9:30 p.m. Singapore time, which is the employment change and the unemployment rate. So consensus is expecting the unemployment rate for Canada to inch slightly higher at 6.9% from 6.8%, and also a rather lackluster employment change number as well. A reduction of 25k from previous 50k added. So what's interesting over here will be at 9:30 p.m. as well will be the non-farm payroll data for US. So market is expecting a rather low ball number at 160k. Previously 227k. So given a low ball number, it could be easily surpass expectation. All right, so there could be some kind of volatility in the market that upon the release at 9:30 p.m. Singapore time, when they release the non-farm payroll data, volatility could be upside volatility over here. Okay, both squeeze up and squeeze down in terms of the FX market and the major stock indices. So do keep a close watch on those key levels that I highlighted to you on the intraday basis. When I just a while ago, I covered the intraday technical outlook segment, all right, on the major FX pair and the major US stock indices. And the unemployment rate was also out at the same time at 9:30 p.m. will remains unchanged at 4.2. And another top tier US data to look out for will be consumer sentiment. Why? Because we know that US is economy. Three-quarter of US economic growth is potentially driven by services activity, which is retail spending is one of them. And in order for retail spending to remain robust, we got to have very robust consumer sentiment as well. So this University of Michigan consumer sentiment is considered as one of the top tier 1 US economic data that could induce higher volatility as well on the relevant markets will be the flash preliminary figure for January, out at 11 p.m. Singapore time. Market is expecting almost unchanged, 73.8. Previously it was at 74, so I'll say that it's almost unchanged over here. So over the then potentially this is not out yet, so I'm not sure what time will be out. This key China data will be loan growth. So loan growth has been very weak in China since the almost 1 or 2 year, almost a year, because of that deflationary risk spiral. So if we're going to see rather weak loan growth again, there could be risk of further negative feedback loop on the China stock market and as well as the Hang Seng indices. So this one, there's no timing yet. So it's either today or next week over here, because